Right, so welcome back. Wanted to just point out quickly, also half in response to Jared's question, asking, what are we going to trade? Is it going to be class one, what have you? And maybe I should have also, in fact, I definitely should have pointed this out in the introduction to today's sessions. Is part of the main objective for me here is to get you folks thinking outside of the box. Now, I did mention this morning that our strategies are derived from these concepts and these principles that we are able to identify at a technical level in the markets. And that is absolutely true. But the goal for you, I think, should be to get to a point where you can start coming up with your own ideas. Now, it's all well and good being spoon-fed by me, and obviously I do provide you folks with strategies and ways of trading that take advantage of these, and perhaps you've already started seeing how, for instance, the impulse strategies and so on come out of all of these concepts. They simplified versions, if you like, and that's really the idea, is to put together a systematic approach that you can follow and take every trade and be consistent with, so that you can get the law of large numbers working for you, etc. But at some point, you need to start thinking for yourself as well. It doesn't mean that we obviously in the academy aren't doing that. We are on an ongoing basis. But for me to be able to take any one person outside of the box, well, that's not really going to be for me to do. That's for you to do. So when you get to the point where you're ready to step outside of the box and start thinking a little bit more broadly and maybe coming up with your own ideas, well, this, I'm hoping, will give you a foundation for being able to do that. When you can see what all the Lego blocks look like, you can start putting together Lego blocks in your own way. Obviously, abiding by the important principles at all times, which really, at the end of the day, come down to the three pillars. You don't want to move away from convexity necessarily, unless your strategy that you're coming up with has, for instance, is an overlay, where you're not necessarily looking to be profitable, but where it will certainly help you in your trading somewhere in that portfolio strategies that you have. There's nothing stopping you from being able to do that for yourself. So it is also my hope that this training will empower you to be able to do that. You might not feel ready for that. So there's obviously varying levels of expertise amongst the folks attending today, and anyone who might be watching this in the future. I mean, some folks have subscribed to get the recordings because they can't make it today during the working day. But at the end of the day, no matter who you are, at some point, I'm hoping that you will be able to get to that point of understanding how things work, so that you can come up with your own ideas. And even if you're not, when you start trading a strategy, because there are some really new folks here as well, if you start trading any of our strategies, you will have a better idea or understanding of how and why the strategy works just from attending this training. So Greg's also asked about the alpha trading. So alpha basically means it's derived from a term in the fund management industry, where the difference between an index tracking fund and a discretionary fund manager is normally in what is called the alpha. So alpha is getting additional return over and above what you would normally expect to get. And when we start looking at the triple time frame approach, which is what we're also going to be doing here, then clearly that is something that should, the idea behind that is, of course, to be able to get additional alpha. And that's why it's called that. But in and of itself, we're going to look at different ways of doing that and different ideas behind how these, not just strategies work, but how you can actually interpret the market in your hunt for high quality price movement. And we are going to focus on that. As always, as convex traders, we are always on the hunt for high quality price movement above all. All right, so that being said, let's take what we were discussing earlier and start putting it together. And I'm going to just use as an example a day last week, which was probably over a couple of days, but it was really 1 day's trading that was of interest, and some of you folks may have taken advantage of that. But the fact what happened in the past is not so important in and of itself. It's really about saying, well, if that were to happen again, or something similar were to happen again, which it always does, will I be in a position to use these concepts to be able to trade? Now, I'm not going to delve into strategy rules here. I'm going to use some basic principles, and doesn't mean that I'm describing a strategy, but obviously in terms of being able to understand how you could have benefited from this, I do need to talk about, well, here's an entry based on what you already know. Where would the stop go? What would we do? How could you trade this? I am going to look at that, but please don't take it as if I am describing a fixed set of strategy rules today. That is not the purpose of this training. This is about technical analysis, it's advanced price action technical analysis workshop. And that's our focus. It's not about being able to then say, okay, given all of that, what's the strategy? Where do we get in? Where do we get out? Those are all strategy rules. That's timing and management. And much as I may touch on that, I will touch on that in certain ways. It doesn't mean that I'm trying to describe a strategy to you guys. It's just about saying, well, this is kind of in your face. Why would you not take advantage of this? So hopefully you'll see that. All right, folks. So I also revised things like the HTC channel earlier on purpose as well, so that we can add that as a Lego block in all of this. And you should be familiar with that anyway, because you can't necessarily, or you shouldn't necessarily just look at the wave patterns on their own. They are obviously useful for helping us to identify when and when not the market conditions are appropriate for us to look to trade. And as always, it comes down to that question, do we have a trend? Yes or no? Right, so here we have a familiar picture with the market having ranged for some time. I'm going to look at this across 3 time frames. So I'm jumping straight in, and obviously, jumping into the deep end is a bit risky because it might lead to people getting a little bit confused, but I think you will notice that once you get the basic idea right, then adding another time frame onto the 2 that most of you are already familiar with is not a big deal. And those folks who have attended already some of the sessions we had on Discord will already be familiar with this, but many of you are not. So don't feel like it's a big deal, because it really isn't. Okay, so what I'm going to do as well is I'm just picking 3 time frames here that are pretty useful for lower time frame trading as well. So it helps with intraday trading. But again, these principles also apply to the higher time frames. So my primary selection time frame that we're on right now is H4. But this could just as well be a weekly time frame. My secondary selection time frame that I'm going to look at is the M30. I might even look at the 15 minutes, but the execution is going to be on 5. And you might say to me, well, why those? Well, again, I'm trying to show you principles here that you can use. When you're looking to understand the principles, you can be pretty flexible about what you're looking at. Of course, at some point, you need to nail it down. But right now, I want to show you just what the broad brush picture looks like. So let's jump into it. Here we have a market where on the right-hand side of the screen, you can see we've had a breakout from an HTC channel. We've clearly got our 4th wave, which is incomplete on the right-hand side. I might show you what happens obviously further on as we look at this. I do try to reveal it over time. And in the end, obviously, that's because that's how it actually works. But regardless of whether we know what's coming next or not, it's about following these principles. So here's our reference wave. Obviously, here's the bottom of our HTC channel. There's the top of the HTC channel. If you were using the LPO, you'd notice, of course, that it would be wider than this, because the LPO would have been all the way back here and false breakouts along the way. And remember, if you're using both of them, we take the first breakout. So here was the first breakout that we had. And we're into a retracement wave. This is a W pattern. It's a bit of a messy one. This wave over here was one of those examples where we had an isolated high, but we didn't have an isolated low, but then the market really got choppy. And we ended up with that. So it doesn't really matter, okay, at the end of the day, what happened inside of this wave over here. We still have the same channel boundaries, and we still have the same breakout. All right, so if we do take that, this would be a class 6 pattern, because that's our reference wave. We had a bullish impulse wave followed by a bearish impulse wave. That's not what's important right now, because we're not ready to trade just yet. What we're looking at is the fact initially that we've got a breakout. So what happened next? And let's see how these patterns resolve themselves over time. So here we have a bearish engulfing candle, pretty much what we were looking at this morning on today's trading, so today's markets. And I like to advance my my analysis for an engulfing candle. If it ends up being wrong, I will backtrack. So that's not a problem. But what do we have now in terms of our patterns? Well, clearly, this is a class 1 M pattern. Well, it's an M pattern. You can see it's an M. And it's a class 1. Why? Well, if we were to draw in all of those lines that we did earlier, they're all pointing down. And from a sort of a more traditional way of looking at this, you can see that this phase 2 wave does not encroach in any way, shape, or form on the price territory of the XA wave. So X to A to B to C to D. So the BC wave is outside of that price territory. Very clear class 1 M pattern. Now, would you look to trade that right there and then? Well, yes, certainly you could drop down. But you could even look to potentially trade this a little bit earlier, especially if you were looking only at 2 time frames. Now, that would be around a discussion of a hybrid strategy. So I'm going to point that out for you. Okay, I'm pointing these things out so that you can understand how it ties into what I've already taught you in the academy and what you've seen many times in the market reviews and so on. If we were in a market where we have reason to believe that we're in a trend, and we had that immediately, we had that breakout, then what? Well, let's take it back even a little bit further. As soon as we got that bearish breakout, and that would have applied because this was still the bottom of our HTC channel, then what? Well, you could have then dropped down to the lower time frame immediately at the close of that candle, because we need to have that candle close, and which means I need to just progress that one. And at the open of the next candle. Now, we don't know what that candle is going to ultimately look like, but what I'm going to do now is just drop down to the 15-minute time frame. I just need to make sure that this is all set up for me to do that. Well, mess it up completely. Supposed to have our little triangle at the bottom here somewhere. It's not giving it to me. Well, never mind. Doesn't matter. Let's pull it back again. Right, so there's the triangle. Now, unfortunately, of course, because we've had that big move over here, it really makes the dimensions of this look a little bit trickier. So you can see that we want to take that back a little bit further so that we can look at what was going on at the open. Now, the open of that 4-hour candle is exactly where this horizontal line is, which is also the open of this candle. So it's before during that high, which means at this point in time, this was also on the, this is the 15-minute time frame. Just bring that back a little bit. And folks, please bear with me, but this is now what it's going to be like for us as we walk our way through these patterns. So as we had this pullback, and remember that we were just looking at the close of this candle and the open of this candle. I'm not saying you would be trading around this time, because clearly this is midnight. We had what is a class 4, I believe, pattern. Let's just put in a horizontal line here so we can just double check that. Yeah, you can see none of these candles closed above that low, which means it is a class 4 W pattern. Pretty clearly at this point in time. And this is our CD leg. with D not yet defined. It's obviously floating, so D not yet changing to a C in that W pattern. What would we do at this point in time? Well, I'm going to ignore the hours for now, okay, but it's we do know that this was around midnight. We would never be trading the lower time frames around this time. So you can quite happily skip forward a little bit, which is what we're going to do, to a point where potentially we would be interested in looking to start to trade any of these markets. Now here you can see how that class 4W pattern has flipped over into a class 1M pattern here on the 15-minute time frame, bearing in mind that we are still in just a breakout wave on that higher primary selection time frame, being the H4 time frame. And I know many of you are going to say, well, why are you going from H4 to 15-minute time frame? And again, that's not the point. The point right now is for us just to be able to look at how different time frames actually can combine and how you can use that to open up ideas for you. It's not necessarily because I'm recommending it or saying that you can set this in stone. Right, as soon as we had this low ringed, which took a couple of candles on the 15-minute time frame, we got a class 3W pattern. When you got a class 3, you immediately assume ranging. Now, obviously, when we'll talk about class 3 patterns, you can use them in very aggressive trading, particularly with aggressive hybrid trading, where you can use a class 3 pattern on your execution time frame. It is aggressive. You're going to have a lower success ratio, but for now, we just want to recognize that as soon as you get a class 3 pattern, that means that the cyclicity that you previously had, which obviously was bearish, has come to an end. So then we had phase 1, phase 2, phase 1, phase 2, phase 2. That's basically what it's telling us. That phase, that is a phase 2, and it's confirmed by the fact that that's a ringed low. Excuse me. All right, so let's just move it along. We wouldn't be surprised about that because we'd probably be fast asleep. Here we have another class 3 pattern. Why? Despite the fact that that's an impulse wave with a lower, lower, lower close, we are still inside the price territory of the X to A leg. So class 3, no question about that. What do we have now here? So this is one of the interesting things. As soon as you get an impulse wave or phase 1 wave, you know that the next pattern, because the preceding was an M pattern, you're going from an M pattern to now a W pattern. We know that that W pattern is going to end up being potentially a class 4 or class 5 W pattern. Right, so until we had a close above that low, and again, I apologize, this is quite detailed. I suppose I can expand it. I don't want to mess things up too much. I don't think it makes that much difference though. No, it doesn't. As we move away from all of that that bearish price movement, it'll make life easier. But here we've got a W pattern. At first, it was still a class 4, but as soon as price moved above that low over there and closed above it, it went from a class 4 to a class 5, remained a class 5 all the way. Then we got that high ringed, and the sooner we can move on, the better. No, not yet. There we go. Make life a little bit more visible, even though we're revealing things. Okay, so you can see that that made a slightly higher high, but did not make a higher close. So the fact that that ringed high, as soon as this candle closed and ringed that high, even though it made a higher high, that is not a phase 1 wave, it's a phase 2 wave. And not only that, it's bearing in mind that over there, because that is a lower, lower, lower close, this is a class, it was a class 5W pattern, which means it's now a class 2 M pattern. And that very often happens as well. So a class 5W will flip over and go into a class 2M, and of course, vice versa. So there we have that. And if you're really struggling with, you know, the class names over here, I want you to always come back to the common sense application here of cyclicity and what type of waves we are looking at and the fact that instead of just looking at individual waves or even individual cycles, a cycle is 2 waves. We're looking at combinations of 2 cycles, and that's giving us very, very valuable information. All right, so this was because of that lower low, lower close, a class 2M pattern. Did it go anywhere? Well, no. So that came to an end there. That low was ringed at the close of that candle. And here, once again, we have another class 3W pattern because that failed to make a higher, higher, higher close. You'll notice that this gave us a higher, higher, higher close once point D was here, which means that we know that we're in for at least a class 2W pattern in the future. Right, so, and at first, it also would be a class, well, in fact, a class at this point in time. Yeah, in fact, at this point in time, this is a class 4 M pattern, higher, higher, higher close. D, we do not have any closes until that point in time over there. We don't have any closes below that price. So let me just double check that. Yeah, so that's a higher close. That's a higher close. It only closed below there, but technically that's now in the next wave. But remember, when we have that inside bar before this low was ringed, and that was just an inside bar, we'd recognize that this could potentially have gone further. You know, we would be treating that as a class 5. Anyway, flips over back into a W pattern. And in this W pattern, we want to look at the lowest close between B and D. And you'll notice that it's there, which is in fact inside of X, which means that we would then treat this as a class 2 W pattern. Had this close been above this horizontal line, in other words, above that price level, we would have treated it as a class 1. Now, we're not using this at the moment. Why? Because we know that on the higher time frame, on our primary selection time frame, we are in fact in a retracement wave, aren't we? So going back to H4 briefly, we are now in this bullish movement over here. So it is just a retracement wave. How does that help us? Now, remember, we have reason to believe that a trend may be starting thanks to our breakout. But we're in a retracement wave of that trend. So what are we looking for? Well, we're looking for the end of the retracement wave, aren't we? Now, what would signify the end of a retracement wave? Well, if you're using one time frame, it would be a ringed high on this single time frame, wouldn't it? But if you're using 2 time frames, and you could drop to a secondary selection time frame, this wave is a trend, as you know from your trading. It's a trend, and that trend, when it comes to an end, will signify the end of that wave. Now, remember, if you have reason to believe that you're in a trend, and a trend is defined as an intact sequence of phase 1 and phase 2 waves, when a phase 2 wave comes to an end, you now have reason to believe that you're into the next what of that trend? Phase 1. And folks, phase 1 waves are the high quality price movement. That's what we're looking to capture. I know I've said this a zillion times in our training before, but the recap I think is still important. We are after the high quality price movement. That's what we are hunting. All right, so this bullish trend, whether it's strong or weak, we're not interested in trading it because we know on the higher time frame it's just a phase 2. We have no reason to think it's anything else. I don't actually know if that made an isolated high. So 299. No, yes, it did by 0.1 of a pip. So just sticking with my rules. Go for a W to an M pattern. Now we are looking at that price level. And you'll notice that this is a class 4 M pattern because it didn't close below, nothing closed below this level over here. So a class 4 flips over into a class 1 W pattern. That's what I mentioned earlier. A class 4M will flip over into a class 1 W, and a class 5M will flip over into a class 2W. Now, you can actually use class 2s as well, as you'll see in the future. It's not that you can't. And you can see from this as well in this pattern that we basically actually on the 15-minute time frame got a strong bullish trend. But we also know that we're going against the direction of the higher time frame trend. All we're really looking for is the end of this. Okay, so there we have that again, flipping over into an M pattern as soon as that was ringed. Let's see what kind it ends up being. See, it's testing it, and boom, there it is. So you can see how it came down, ringed it with that candle over there. Okay, you can see how I'm giving away some of the story over here. In fact, we don't really want to see these in this time frame. So let's just keep in the higher time frames. Okay. Right, so flips over from that class 4 into a class 1 again. It's still intact. This bullish trend is still intact. We can't touch it. It's now 7:30 in the morning. So you'd have woken up, you'd be in front of your computer screen, you would have noticed everything that happened during the course of the evening. You would have already been aware of the fact that this is worth looking at because you did your technical analysis the night before and saw that bearish breakout on the 4-hour time frame, and you're now ready and raring to go. You can still see that this over here, by the way, at the top, this broader light blue line, that is the bottom of our HTC channel. Don't forget that. So we are still outside of the channel on our primary selection time frame. But this bullish trend is still intact. But now we've got a bearish engulfing candle. So what's happening here is it's flipping over from a W to an M pattern. Not only that, but it's immediately closed back inside of that price territory. So we know that this cannot be, once this candle has closed, this cannot be a class 4 M pattern, which means that we cannot have a class 1 W pattern after this. We already know that, no matter what else happens. It gets even more interesting because now we've got a phase 1 followed by a phase 1. What does that tell us? Well, it tells us that we've had a breakdown in the sequentiality of cyclicity here. And if I was just to steal this and use it as a trend line, well, I suppose that wouldn't be the best way to do it either. As we got this bullish cyclicity through the night on this time frame, you'll notice that it respected the trend line. Even there, tested it a bit, but it didn't break through. Kept the cyclicity intact. As cyclicity breaks down, it breaks through the trend line. Now remember, a trend line is in fact a support, in this case, level or resistance, if it's a bearish trend, as dynamic. So dynamic simply meaning that the price level is changing over time because it's not horizontal, it's a diagonal. So we get that bearish breakout. Now what do we have, folks? Well, this is just because we've got this bearish impulse wave over here doesn't mean that it's not a class 4 or in fact 5 M pattern stacking up. But we're not interested in trading that, obviously. We want to see what happens next. Now, the main thing to recognize here is that this bullish cyclicity has come to an end. And this is still our secondary selection time frame. Just remember that. Okay. You could use this as an execution time frame, as I'll point out just now. Here's our first retracement. So it flips over into a W pattern. What kind of W pattern? Well, this is a class 6. Okay, these are interesting. Class 6 is interesting because they very often will, if you're seeing the end of a trend, it's showing a potential reversal, especially because you've got a phase 1 followed by a phase 1 pattern. You'll know that trends come to an end either with a phase 2 followed by a phase 2, but sometimes it's phase 1, phase 1. If you're an Elliott wave trader, you're looking for a 618 retracement over here. That's even a strategy that we used to teach back in the day. It's still actually a great strategy. But in any event, here we're seeing that initial turnaround. So now what? Well, if your phase 2 wave, which is a trend on the sorry, let me say that again. The phase 2 on the primary selection time frame which is the 4-hour time frame, is a trend on the secondary selection time frame, which is this time frame. That's what it is. That trend has now come to an end. If the trend has come to an end, it means the wave has come to an end from a technical perspective. So again, if your phase 2 wave in a trend has come to an end, you have reason to believe that your next phase 1 has started. Now, what we want to do is try and capture as much of that high quality price movement as possible in that next phase 1. So that just leaves us now with the goal of identifying an entry that allows us to limit downside and maximize upside, convexity. That's what we're now looking to do. How do we do that? Well, now we go from this secondary selection time frame down to our execution time frame. That is why we now can use the third time frame. We've used the primary selection time frame to give us direction. We've used the secondary selection time frame to help us identify the end of a retracement wave in that direction. So we've got bearish direction from the primary selection time frame. We've got a retracement wave on the secondary selection time frame. We've identified the end of that retracement wave, which is by using the cyclicity and the trend and using our patterns coming to an end. Now we need to identify an entry. So potentially, we don't know, because this could go up. Okay, anything can happen. Anything can happen, but we need to wait and see. Right. So the first thing I want to do is now drop from this time frame. At the close of this candle is the open of this candle. We wouldn't know that it was this bearish candle, but I need to drop down to show you what it looks like. And that would be on, in this case, the 5-minute time frame. So now this is what it looks on the 5-minute time frame. Let's put in our patterns as well. So let me move on from that. I'll sort of talk you through this as well. You can see here on the 5-minute time frame, I had my 4-wave pattern before we saw the breakdown of that sequentiality of cyclicity. Not that I would necessarily have been doing that then, but let's just pop this in here. It gets a little bit messy, but the green lines obviously are our secondary selection time frame, and the red lines are our execution time frame. Right, so here again, you'll see that this is a class 6W pattern. Can't really use that, but we really want to do exactly the same thing that we did earlier. We want to identify the end of this wave, and we want to look for an indication that bearish cyclicity is starting. So when would that be? What do you think? If we want to jump into the market in a bearish direction here, what would be the best type of class pattern to have? And of course, the answer would be, as Jared mentioned earlier, a class 1. Clearly, class 1M pattern. Class 2 wouldn't necessarily disqualify it either, because both of those are trending patterns. So are we going to get one? I'm actually jumping the gun here. I don't really know. We need to have this higher isolated. So let me not do that. Oops. I'm really making my life difficult. Right. Well, in actual fact, it gave us a higher high. And it's a bullish candle as well. So that was potentially going, it didn't ring that high. That's slightly higher, that high. So we're not out of the woods yet. Ah, there we go. Now you can certainly see that, remember that's our secondary selection time frame. That high has now been ringed clearly. And, oh, dear me. This is always a potential problem. Great. Back where it belongs. All these lines. Okay, so now what do we have? That high has been ringed. We now have a class 1M pattern on the execution time frame. Now, if you want to be really aggressive, you can just jump in right there and then, but most of you know that we look for one final signal. And I know that I'm moving now into timing, which is strategy related. So that's not the analysis side of things. But the use of our technical analysis, the price action technical analysis, using these WM patterns in conjunction, obviously, with the fact that we are outside of a channel on our primary selection time frame has helped me to identify the start of the potential at a very early level, at a very early stage, the start of the next bearish impulse wave or phase one wave on that higher time frame. That's on the primary selection time frame. Now, I don't know that that's going to happen. Normally, we like to have a bearish impulse candle. Clearly, this is a hammer or low test, so that does not qualify for that. That's not so important for our purposes right now. But you'll notice that it was, in fact, a good indication. Remember, we're not here to try and guarantee trades or predict trade outcomes. Okay, that's not the case at all. We're here to take probabilistic decisions and nothing else. So, really confusing the issue here. As soon as that low was ringed, we've now got what? Which is the end of this candle. We've gone from a class 1M to a class 3W, which on the execution time frame means we are back into a sideways market. So this is where you would typically look to go back up to your secondary selection time frame at this point in time. Doesn't mean it's not going to start anyway. And ask yourself, well, are we still in that wave? And the answer is yes, we're still in that wave. You can see here how it's continued to come up. So that was like a false start. It was a false indication of the end of this retracement wave that we saw in the execution time frame. No trade. We might have had a trade if we'd got that bearish impulse candle, would have been a loser. So now what do? We go back to square one. We go back from that execution time frame, back up to our secondary selection time frame, and keep looking. And bam, now you can see things are starting to get quite interesting. This would require us, with that bearish candle, obviously it also ringed that preceding high over there, require us to move this on. Now we are still, by the way, outside of this bullish trend has still come to an end. We're still seeing the potential for a reversal here. Obviously, we did not get a higher close. So we got phase one, phase two, still potentially the start of a bearish trend here on the secondary selection time frame. Now, what do we do? Now, remember again as well, as this was progressing, I want to take you back a little bit. As this was progressing, you are still going to be dropping down to the lower time frame, execution time frame, to identify the end of that. So, as we saw that starting to carry on, just try and go. As we saw this bullish resumption over here on that higher time frame, in fact, this is an example of continuation. Because these were both inside bars, so that's actually wrong. That was continuation. I'm just going to put that there. This is continuation. So we still got a W pattern here, class 3 W pattern, continuation of this wave. This looks like it was isolated. It was isolated there. High isolated. And I'm just going to hide these because they're getting in the way somewhat. Too many lines in the chart. One more. I'll leave the blue ones there, they're not getting in the way. Right, so here we've got our M pattern. It's looks like managed to be a class 4 M pattern. That low is ringed. Clearly bullish cyclicity still intact. We're not interested in trading in a bullish direction. We're looking for a bearish setup. And of course, now with this big fat bearish candle here on the 5-minute time frame, class 6 M pattern. And we know that a class 6 M pattern can very quickly turn into something more interesting. And by the way, we were looking just now on that 30-minute time frame. I beg your pardon, 15-minute time frame. Here it is, where we saw that cyclicity of that trend break down. You're seeing a carbon copy of that here on this time frame. Can you see that? You should use one of those green lines, but I could take one of those green lines and draw this here, and you can see it's almost a carbon copy of what we saw on the 15-minute time frame. But now we're on the 5. So phase one, reversal pattern over here, and we still need to wait. We don't have everything that we need. Comes down. A lot of people would start thinking, oh, we've missed the trade. No, you haven't. This is not about catching moves. It's about taking advantage of what the market does. And here we have another aggressive. Remember, we saw aggressive reversal with phase one on the 15-minute time frame. Here we're seeing it on the 5-minute time frame, and it's also giving us quite an aggressive pullback. That, by the way, is also part of Elliott wave theory. The first retracement wave in a trend is usually the most aggressive. It's wave 2, and it averages out at a 618 retracement, just as a matter of an FYI. I know you guys love this stuff as well. Look at that. Bam. I'm not sure if it might go further, but look how that came back to the 618 level. Let's see what happens next. Inside bar, interesting. Okay. Doesn't mean the wave's over. Remember, doesn't mean it's over. We need to have that high ringed. Is it going to get ringed? Yes, it is. Look at how close that came to the 618 level. Isn't that amazing? Okay, so let's move on. What have we got now? We've now got a class 1 M pattern with an impulse candle. Unlike what we had here, where we also had a class 1 M pattern, but we didn't have an impulse candle. Here we've got the bearish impulse candle. And that, folks, kind of would be the last thing that you need to look at in order to take a trade. So I'm sure you would all agree with me. Okay, so the fibs was just interesting to see the fibs come back to that level, as it so often does. Remember, it's just an average. That is a strategy, by the way. If you guys are interested in that, we can talk about it in the future. It's called the 2618. And some of you have been with me for many years will remember that. Okay, so that would be an entry. Now, of course, we can talk about where's the stop go, what's the take profit. Let's just mess around with this. And not get overly complicated. Let's bring these over. Let's just go with an entry, obviously at the open of the next candle. Stop at or around the preceding fractal. Right, so obviously now you can see what happens. But that would have been the entry. I'm just going to go with that, and I'm not even, well, let's see what this was. This is about 12 pips, so let's make it take profit 24. I'm not going to bother with any other stuff now. Let's just focus on the principles and change it to my pretty color of my pretty blue eyes. And put that in there. Okay, so you're obviously going to see that what happens now. It doesn't really matter. So now what next? Okay, I'm not going to talk strategy now. I'm going to take the basic. I'm giving us a 2-to-1 reward to risk. We can use the 3-6 rule to manage our stop to break even and have a fixed take profit. So that means we will, on average, I mean, if we're using the 3-6 rule to manage the stop to break even, our average loser is normally about 0.6 of our initial risk. Obviously, our winners are all going to be 2 times initial risk. So we're going to have a reward to risk ratio of 2 divided by 0.6, which is obviously more than 3-to-1. So call it 3.3-to-1 initial reward to risk ratio. Hey, if you're only winning half of these, you're styling. Okay, you're absolutely styling. So let's see what actually happened, and we can keep up with our analysis as well, just for a bit of practice. So that carried on going down, giving us a nice continuation there of class one. And obviously now we are talking about our execution time frame. Trade management, typically in terms of what we've done also with our impulse strategies and so on, as we manage the trade on the execution time frame. Do you have to do that? No. But again, this is beyond the scope of our discussion today. It's all about strategy being timing and management. We're focusing on selection here, which is technical analysis. Okay, so remember, we're looking to catch the bulk, or we're looking to catch a high quality price movement of the next impulse wave on the primary selection time frame. So this is where our entry was at the open of that candle. Let's go up to our primary selection time frame. Now we're inside of this bearish impulse candle here on the H4 time frame. That is where our entry was. So if you were going to enter using H4, you would only enter at the close of this candle. But what we've done now is obviously we've used a lower time frame to pinpoint a much more exact entry based on evidence that the market is giving us that this retracement wave is over and we're into potentially the next impulse wave. That's what it comes down to. If we go to our secondary selection time frame, here's our little green lines. You can see that clearly. I mean, we would have entered somewhere inside of this candle. In fact, it would have been at the open of this candle, you can see. So the close of that inside bar and the start of this this candle, you know, that inside bar, you'd ask yourself, what do I do with that? Well, you don't know. Okay, you absolutely don't know. You could potentially have also, just using two time frames, you could have said, well, I'm going to enter at the close of this candle and the open of that candle. Sure, but then your stop would have been up here, so you would have, your leverage is lower. Therefore, you know, your potential to your risk to reward ratio is probably going to be lower. In other words, the market needs to go further in order to get the same reward to risk ratio than what we're doing by pinpointing an entry on a lower time frame here on M5. Okay, so we know what we're looking at on the higher time frame. I'm just going to run through these over here. You can see that if you did, and again, I'm kind of forced to talk a bit of strategy here. If you were looking to manage this using the 3-6 rule, you know, by the close of this candle, your stop is almost at break even. And what happens then is it runs out of steam, doesn't it? So I'm not going to get into all the other stuff, but if you were using advanced targeting, it wouldn't have stopped you out using 3-6 rule. But now you've gone into a class 3 W pattern. Now remember, that means that this bearish trend on this time frame has basically come to an end, because we've had a breakdown in the cyclicity, phase 1, phase 2, phase 1, phase 2, phase 2. So now we've got the 3 R's and we assume range. Okay, now that's what a class 3 pattern is. Now, if you were looking for an LPO, you wouldn't bother with that now. But if you were going to do an LPO, well, there's the last phase 1, isn't it? So you would potentially be looking to use that. So that gives that to you. And that, as you can see, is the XA leg in your class 3 pattern. In any case, so we just advance our analysis here. And this is a class 3M. So I went from class 3W to class 3M, back to class 3W. It's a ranging market. That's what class 3 patterns are basically telling you. There's a bearish impulse candle. I'm going to advance this temporarily. Now that it's class 3M pattern. Yep, that's ringed. So on we move. That's ringed again. And because we didn't actually get a lower close there in that wave, it's still a class 3 pattern. But now things start moving again. Okay, and this is resumption, folks. Remember the 3 R's? It ranged for a bit. Now we get a resumption. And boom, Bob's your uncle, it would have hit take profit. Okay, so just using that. I don't want to get bogged down with strategy stuff. I'm just showing you the principles. Okay, so that trade done. Nice little 2-1, or if you, I'm just going to stick with, let's say you risk 1%, so you've made 2% profit on that. Now what? Well, let's go back to our primary selection time frame. So the open of the next candle or the end of that candle that hits your take profit. We go back to H4. Well, we've probably got moved on because that vertical line is gone. There we are. Okay, so we obviously hit take profit here somewhere, or well, further down probably. Hit take profit somewhere along here. Can't see where it is on this time frame. So that was what we were looking to do, is to capture some of that high quality price movement. And obviously the strategy rules will determine how much you do of that. If you use advanced targeting or standard targeting, whatever the case may be, all of that's a different question. But you captured at least a chunk of that high quality price movement in the next impulse wave of a trend on your primary selection time frame. And that's the name of the game. That's the name of the game, as you know. Right, so let's move on. We are still in an impulse wave of this, aren't we? So I should just don't want to go too fast. We're in an impulse wave of a trend on our primary selection time frame. Go for it. That's what you're looking for. We're not over yet. So we go back to our secondary selection time frame. And obviously this has also progressed. Excuse me. I think it would have, where did we have take profit? It was somewhere down there, wasn't it? Kept it in place. How was it? Yeah. Okay. So we hit take profit there on that little tail, which means it was here. Okay. So we hit take profit inside of this candle. And if we're just looking now at secondary selection time frame, you can note that we actually did have a little bit of a wave take place there. And we can advance our analysis to that isolated high. Some people wouldn't, because it made a higher high over there, but honestly, we don't really care. It's an inside bar did give us an isolated high. Let's just keep life simple. We are in a remember, we were in a trade already, so we're not too fussed about any of this stuff because you're in a trade. And this is where we hit take profit. Okay, now there we have an inside bar as well, a continuation. Well, that is inside that bar. That is still inside that bar, even though it's not inside that bar, doesn't matter. But that is the lowest low. And then we did get, you see, there's a lower high, because they were inside. And now we get a higher high in that next candle, which means that that low there is effectively ringed. And folks, this is actually quite an important thing that I know some of you struggle with sometimes, is when do we know that's ringed? Well, you can see there's a sequence of lower highs here until we get to that one. That higher high means that that low is now ringed. Okay, now what is this? It's a class 4W pattern. Excuse me. Class 4W pattern. How do I know? Well, the CD leg, we don't have a D close inside of that preceding wave. So we've still got, we've got bearish support being broken. And once it's broken, it turns into resistance, and it's being respected as resistance. So back it comes. Now, remember, when we're inside of this phase 2 wave, which is quite flat, what are we looking for? We're looking for the end of this phase 2 wave. And how do we know that? Well, we look at the cyclicity on the execution time frame. So let's just drop down to that. Oh, right. Excuse me. Getting carried away. Right, execution time frame. 5-minute time frame. Let's just update our analysis here a bit. That's where it hit take profit. And now you'll see. Now that's obviously a class 4W pattern, which initially flips over into a class 1M pattern. But then that low is ringed at the close of this candle. Close of that candle there, which means we're now into class 3W pattern. So what do we assume? Range. Okay. Now remember, we're in a bearish trend on the higher time frame. So range on the execution time frame is just a flat phase 2. That's all it is, potentially. But we can't execute until we get a class 1 or a class 2 M pattern. class 3 M pattern, class 3 W pattern, class 3, no, class 4, class 5, I think, M pattern that closed just inside that price territory. Regardless, I mean, the thing is a class 4 M pattern can only be a class 1 W pattern, which means it's going in the wrong direction. I don't know if that was ringed actually. No, it was. Okay. And we're back into the same kind of analysis that we were looking at here earlier on. We're in a phase 2. We're looking for this bullish cyclicity to come to an end and for bearish cyclicity to reestablish itself in a class 1 or class 2 M pattern. And I'm just saying, you could restrict yourself to class 1 for sure. And if you use class 3, that's hyper aggressive. That would be the most aggressive form of hybrid, would be a bearish impulse candle in a class 3 M pattern. And you can see we don't have, I mean, we had one there actually. Yeah, so there was a bearish impulse candle in a class 3 M pattern. That would be hyper aggressive, and of course you would have been stopped out, which is one thing that happens a lot when you are trading hybrids, especially using class 3. Here's another one, class 3 M pattern. Okay, there it is, class 3 M pattern, bearish impulse, you know, a hybrid setup again. Okay, and that one would have really worked out for you. So you would have had a loser there, but I don't know if this one's going to win. We'll have to wait and see. But you're in. Okay, now if you're trading more conservatively and you're trading the impulse style approach, you're looking for a class 1 or a class 2, which means you're waiting. And there, that low is ringed. We're now into a class 4 W. And there's this pattern again. You could draw in a trend line here. And it's been broken. And you can see that that bullish cyclicity has come to a distinct end with a bearish cyclicity potentially reestablishing itself. Doesn't mean it will. Okay, so now we're in a class 4. If this flips over, we're in a class 1 M pattern, which is precisely what we're looking for. Okay, let's see if we get it. And well, we did actually, because that high has now been ringed, but we're still looking for that bearish impulse candle, aren't we? And look what happens here. It goes back into a class 3 again. Now, if you've taken that hybrid setup, you know, you've trailed your stop, you haven't made any money yet. You're at break even now, or close to it. And you're probably smiling as soon as this happens. Right, class 3 M pattern again. Okay. Now you can't take another hybrid, but that would be a hybrid setup. Class 3 M pattern. We're looking for something more on a more conservative front. We're looking for class 1 or class 2. And well, we haven't got it. Okay, not yet anyway. You might notice that we're now into the afternoon of this day. It started out early at like sort of 7:30ish on this day. It was last Friday. So for those folks who don't trade Fridays, you'll be saying to me, well, why not? Okay, and here we have it. Class 4 W flips over to a class 1 M pattern, and that at the close of that candle, bearish impulse candle, and the open of the next candle is where you would enter. Okay, so open of this candle. Let's see what happens. I'm as much in the dark as you. I'm not using any fancy approaches. I'm just saying what you already know. So there's the previous fractal high, quite an aggressive stop here. Let's see, how many pips is that? Let's see, it's 7.6. So if I was just going to go with the 2 to 1, I'm going to make it 15 pip take profit, a little bit more. Just give it about 15 pips, just over. But of course, I mean, you guys would know by now that that would be the entry. Okay. Sorry, Rooster is outside of my study window. Right, class 1 M pattern entry. Bob's your uncle. Let's see what happens after this. And I'm just going to assume, 3-6 stop management, which means our stop is still hasn't moved. Okay, so that actually ringed that low. We are now into a class. Gee, he has to come right outside of my window, doesn't he? We're in a class 5W pattern. Haven't been able to move the stop even using 3-6. Maybe now we trail the stop slightly. But again, I'm not going to get bogged down with strategy. And that one is a loser. Okay. So we had a 2-1 winner. Now we got a slightly less than 1% loser on this, which means we need to pop back up to our secondary selection time frame and see where we are with that. So if you were a hybrid trader, of course, you're smiling, okay, because you got in all the way over here. You had a loser here, but now you're into a nice trade that probably still running, stop still above that. If you're using advanced targeting, as you very often would do with a hybrid. So that would still be going, but this one would not have worked out using the impulse approach. So we just go back to secondary selection time frame, and you can see that here we are in fact still very much in our in a trend. So that made a slightly higher high. So there's a class 1M pattern with that close inside over here. This is a class 5W flipping over to a class 2, probably you could call it, maybe even a class 3, because we didn't get a close outside over here. But there's your close outside. That's where we had all that mess earlier on. So bearish impulse, just also to have a look at our primary selection time frame and move that on ever so slightly. You can see that we're definitely into that phase 1 wave on that time frame. So here's our secondary selection time frame. Giving away things at the moment. We're still happy with this. We're in that bearish impulse wave. We're outside of it. That's all well and good on this time frame. Now, some people say, well, this is a class 3M pattern. Well, yes, it is, but note that our D close is below X. Okay, so it's similar to the fact that on our primary selection time frame, the direction was fine. We've got that bearish impulse wave. We're good with that. So dropping down again to execution time frame, we're still fine with it. Even though we've had a loser, it means that we're still looking. Okay, we're still looking to see what's going to happen. And right, that's where we were. Still keeps going up. So we're quite happy to have gotten out of that trade. So let's assume that we lost, I don't know, 0.8, 0.9%. So we won 2, means we're up 1.1. And there, bam, it rolls over in quite a big way, which is really frustrating, as you know very well, when you've just been stopped out. And that happens. It's part and parcel of the life of a trader. So accept it and move on. Right, but the point being is that this bearish cyclicity has resumed with a vengeance. It's a class 6 at the moment, W pattern, but we know that a class 6 can very quickly turn over and become a class 1M pattern. There wasn't even really a chance to get a trend line in here, but it's been smashed. And for those of you also on the mentoring program, remember the golden triangle, that's all pulling back into the support level of that previous trend line that's been broken. And there we have another one of those pictures. It's almost like the same picture over and over and over again. And again, not pretending that we're teaching a strategy here, but just doing what is obvious. Obviously, the right thing to do would be the open of the next candle. This is really big. Unfortunately, I can't see what that's saying. So 25. So wow, 50 pip. If we were going for 2-1 on that, not recommending that that's how we would do it. But like that. You can see that now the ATR really starting to expand as these candles start getting a lot bigger. Yeah. Right, so rolled over class 1M pattern, what we were looking for on execution time frame. So our secondary selection time frame and primary selection time frame are all still fine. And let's have a look and see what happens. Remember, we'd be looking to just assume 3-6 rule. So you trail the stop there. So at the close of that candle, just do it so you can see. Right, so now you're going to wait again, that low being ringed. Okay, we are now into you should really know this by now, class 5W pattern. Why is it a class 5 and not a class 4? Because that close was inside that wave's price territory. It did not respect that support, turned into resistance as resistance. Let's see. Okay, we're still not trading any further. That rings that. Now we're into, and you know, class 5 will flip over and become a class 2, which is what it does. Class 2 pattern. Class 1 pattern would require that close to be below that. That's why class 5s become class 2 and class 4s become class 1. Right, we're still in this one. Had you not been in a trade, you might even be looking. Say if there was a lower close over there, using the 2 candle rule, you might have jumped into another one. But we're already in a trade here. Let's see what happens. Oh, and of course, 3-6, 3 lower closes. At the end of that candle, we'd now be at break even, wouldn't we? So we're in a risk-free trade using the 3-6 rule, and we don't take it any further. Now we just leave it and see what happens. Goes into a class 3W. And of course, we're now moving towards the end of the trading day. So it's like, you know, you're not necessarily expecting this to work out. Doesn't matter. Let's see. Ranging a bit, class 3 patterns, class 3W to class 3M. Oh, come on. The technical term for this is pissing about. In case you didn't know. High. Yep, those 2 highs are identical. So this is actually a continuation. Okay. Take that. And of course, it's Friday, so you should have just left it and gone down the pub or something. Moving, because we've got that breakout now, because we've got an impulse wave, we know that this will be at least a class 5 pattern, might be a class 4W. And of course, if it is a class 4, it will turn into a class 1. And it is a class 4 because that's now been ringed. Class 4W turns into a class 1M pattern, but you're already in. So you're not going to take another one necessarily. Doesn't really seem to be going anywhere. In any case, so you'd be in this, you wouldn't necessarily be advancing all of that analysis. And ultimately, yeah, it's Friday evening. So, you know, you've probably taken some money off the table and walked away. And that's that. Yep. Friday evening, nothing happening. So there you have it. Just a quick walkthrough of actually what happened using this approach, using the Euro USD on Friday last week. And I'm only looking at it now and using that because I was messing around with it on the day and it actually worked out okay. You would have had 3 trades. This one, if you just walked away with maybe 1 risk unit in profit, means you would have basically made just over 2 risk units across 3 trades. But you can see that, you know, if your average loser, and I'm just, again, this is talking strategy and I shouldn't, your average loser, if you're trailing, you'll stop using the 3-6 rule to break even well, your average loser is always going to be about 0.6 of a risk unit. Some of them will be the full stop loss. Some of them will be almost nothing. Average is out at 0.6. If we were to use this 2-to-1, and I'm not even looking at ATRs, I'm not getting it, it's all sophisticated with this. just a basic, there's my stop, using a fractal stop and just doubling that up for my take profit, 2-to-1 initial reward to risk. You know, you've then got a 3.3 reward to risk ratio. Hey, if you're only winning 40% of your trades, you're doing all right. You know, so in fact, if you were losing 2 out of 3 trades, then what would we have? 3.3 divided by 2 would give us our expectancy, which of course is 1.65. For every dollar you lose, you'd be making $1.65, which is not to be sneezed at. It's not great, but that's assuming that you lose 2 out of 3 trades. If it's any better than that, you're immediately close to 2-to-1 expectancy. Just doing that. Right, folks. So questions. Let's see if I've been notified of any. No. And of course, any sort of detailed questions we'll be going through tomorrow. Looks like one every time. Jared, can you trade the alpha on one screen? Yeah, you can. I mean, I've basically been showing you all of this on one screen. It's easier with more than one. It's easy. I mean, it's a bit of a pain to do it this way, but obviously I kind of have to do it in order to illustrate how it sort of evolves real time. But it's a lot easier if you have got a screen for, if you've got at least 2 screens. So you can have one screen for your selection timeframes. In this case, I was using H4 for primary and 15-minute for secondary. And then you have a dedicated screen for your execution time frame. But no, you don't have to. It's just nice to have. That's all. Right, folks. So that's the general idea. Gary's also asking something. Gary's talking about class 1 again. Same question that Jared asked earlier. Not necessarily, folks. These are, I'm trying to open your mind to what this stuff looks like and how you can use it without having to go and reinvent the wheel yourself. You know, if you spent 10,000 hours looking at a screen, you would come up with this on your own. No doubt about it. But I'm pretty sure you don't want to, which is why you're a member of the Academy, because I've spent way over 10,000 hours looking at charts in my life. And that's, well, you know, I'm here to give you the benefit of that. Right, so that's really what I wanted to cover as far as that's concerned. Now, there is more, unfortunately. I've shown you the basics of using this across 3 timeframes. Clearly, you don't have to use 3 timeframes. You could just stick with 2, in which case you're back to what? The impulse strategies, H4 impulse. That's exactly what the H4 impulse is. But now you can actually, I hope, see more clearly, you know, why an H4 impulse trade is what it is. And of course, that goes into other rules around timing and management, especially as well, and the different options around that. But when it comes to the selection criteria, be it for daily or H4 impulse across 2 timeframes, you can see how that, you know, that this fits into that. And how those strategies fall directly out of this kind of analysis. But now, when you want to look at an alpha approach, is where you're using a 3rd time frame. It's not different. It's still the same thing, but you're using 2 selection time frames, and that, you know, that there are advantages to that, as you can see. But it makes life a little bit more complicated. Not that much, because your primary selection time frame, it's quite a basic usage of that time frame. You could use this for, if you wanted to use it for the H4 impulse. The problem with that, of course, is that you know, you'd be using your weekly or even monthly time frame for your primary selection time frame. Well, I say it's a problem. It's not really a problem. Alternatively, you could use the H1 time frame as an execution time frame, with the daily or weekly as your primary selection time frame. and H4 is your secondary selection timeframe. So you can do all of that, no problem. Obviously, as we start getting to intraday management, then you need to have a trade manager to help you remain consistent, unless you want to, do what Nevik does and look at your charts every hour or every 4 hours. All right, so there's that. Now, what we could also, and maybe we'll just touch on as well when we get into this tomorrow, is look at the flow of one to another. I've already started showing you that, how a class 4 will flip into a class 1. But when it comes to these, and I've even shown you on the reversals, how you can see a class 6 will often very quickly and immediately turn into a class 1 pattern as well. So that's more for the folks who are interested in doing sort of computer programming, what have you, around these, where you would, your app or your software would identify on your execution time frame that you've got a class 6 inside of the fact that you've got you're in a retracement wave or were in a retracement wave on your secondary selection time frame, and an impulse wave of your primary selection time frame. So or what we were looking at today as well is you can look at the, and I recommend that you look for the end of the retracement wave on the primary selection time frame, looking for the breakdown in cyclicity on the secondary selection time frame, and likewise, as that happens, you drop down to the execution time frame to look for your execution pattern, which would be a class 1, or possibly you could say a class 2 pattern as well. I say class 2 for execution because of that first retracement is very often a deep retracement. That's 618, as you can see. So you don't necessarily want to miss out on those. So yeah, that's really the other part of this, is looking how one pattern leads into another, on especially on your execution time frame. Right. So folks, if you do have other questions, please do put them into our into that the comments in that post in the group, and I will look to address those when we talk tomorrow. So just to reiterate, tomorrow, thanks to our local electricity provider, I will be coming to you with one screen, Jared, tomorrow from the Wilderness Hotel, and we will look at some live markets. Hopefully with the news coming out, we will have some action. I will also be answering any questions you might have thought of asking me in the interim. So, and of course, if you come up with anything tomorrow while we're going through all of that, I'll be able to engage with you directly then as well. So one other thing, folks, that I'd really ask you to do, please, as a great favor to me, is to go to the Facebook page, not in the group, not in the expert tips, but in the Convex Trader Facebook page, and give us a testimonial or your opinion on the training, anything like that. If you could pop in there and just give feedback. Obviously, I would like to expand our reach and get some new members into the Academy, and your assistance in that would be amazing, because obviously, you know what it's like. You the trading world is shark infested waters, and you know, it's difficult to give anyone reason to trust you. And one of the main ways that you can do that is for your existing members to give their honest opinion. So I hope it would be positive feedback. If it's negative, well, I suppose that's fine too. But your testimonials and your opinions and feedback in the Convex Trader Facebook page would be most welcome. I'd really appreciate that if you could jump into that. Awesome, Roy. Thank you. Henk, you're welcome. Greg, glad to have you back, Greg. Been a while. So really nice to see you here. So folks, I am glad you enjoyed today. I know it's been a bit of a gallop. It's been quite a lot of ground to cover, especially with the need to do some recap and revision work this morning. But I hope you found it valuable. Yeah, I'd I look forward to tomorrow where we can actually start looking at doing this analysis real time. It's always much more fun. Good. You're welcome. Richard, yeah, so I did want to ask Richard also to give you guys a bit of, because he's been with, well, he's been trading with me for a long time now, as many of you know, and I would like Richard also just to give you his view on how this pattern trading has worked for him. He's pretty much an expert on it now as well. But I know that it's already quite late, and I didn't expect to go on this long. So perhaps tomorrow we can let Richard chat to you guys as well. So please make sure that you are around tomorrow for our VIP session. We will make the recordings of this available to everybody for the next day or so, but VIP members will have lifetime access to that. So look out for that. And more importantly, please do make sure that you get any questions you might have around this ready for tomorrow, because I don't want to leave any stone unturned. You're welcome, Yanni. Yeah, thanks, Richard. Thank you very much. Barbara Ann, thank you. Awesome. You're welcome, Gary. Right, have a great afternoon further, great evening. I'll see you guys tomorrow. Bye for now.